Welcome to Grow Organically, the podcast where we host candid discussions with wealth management and financial pros. Each episode, we break down factors that drive growth at wealth management firms and how organizations can continue to be forward thinkers in today's competitive landscape. Grow Organically is brought to you by Catchlight. You can access all our podcasts, including show notes and other resources to keep learning, at catchlight.ai. Dan Gilmartin is the host of Grow Organically and is the head of marketing at Catchlight.
Welcome back to the program, everybody. I'm your host, Dan Gilmartin. I'm really excited to have Gary Roth on the program today. Gary's a co-founder and co-CEO of Modern Wealth Management. Prior to founding Modern Wealth, he was a managing director at Goldman Sachs Personal Financial Management. Prior to that, he served as the chief business officer, CFO, and COO at United Capital, a firm he helped build and scale and eventually sell to Goldman Sachs. Gary, welcome to the program.
Thanks so much, Dan. I'm happy to be here.
Well, we had this interesting chat a few weeks ago, you and I, and it was on the heels of your second article that you wrote for CityWire. And I found what you were talking about in those two articles fascinating, and I know you're working on a third. And I thought it'd just be great to share more of your insights in the areas of organic growth with the audience. So let's just jump right in. The three key topics that you're focused on in these articles, and I think you're focused on for your firm, is number one, organic growth. And I think you had an observation in the first article that it's flat. So we'll talk about that. Why folks should care. Great question. We'll jump into that. And then lastly, we'll talk about the tactics. So first article, let's jump into it. Organic growth is flat. There are a lot of numbers out there. Curious to get your take on why you think that's the case.
Yeah, and it's something I've spent a lot of time thinking about over the years, and having had the benefit of seeing a lot of advisory practices over the years, because first at United Capital and then again here at Modern Wealth, we had and we have here an acquisition strategy. And so you see a lot of firms and get to see their sort of underlying financials and key metrics and what's actually happening. And so I think what I said as I led in the first piece on CityWire was, about some of the stats that came out last year that showed a very low average organic growth rate in the industry. Shouldn't be a surprise to anyone who sort of sees the underlying numbers of the firms. And, the stats we see are going to fluctuate from year to year, depending upon what surveys are released and who responds to those surveys. But, what I can say from having seen hundreds of firms over the years is that the number of firms that are growing at what anyone would consider to be a really high, robust rate, I probably could count on one hand. And that's no exaggeration. That doesn't mean there aren't some people who are growing at meaningful rates. But so I think I was kind of motivated to write these pieces to, I don't know, maybe just kind of shed some, what I view as sort of just kind of potential truths as to why that might be the case. And because I think what we hear all the time about organic growth, organic growth, organic growth. And almost with a starting point assumption that advisors who aren't growing at meaningful rates are somehow failing at something. And part of the point of my first piece was many of them are not actually failing at it. They're just not doing it. And they have reasons why they're not doing it. And so I think to diagnose a problem and potentially solve it, you have to understand what is the underlying condition. And the underlying condition for a lot of firms, or a lot of advisors, I'd say, is that they don't see it as a problem, and it's not something they're particularly focused on. Growing organically is not something they're particularly focused on.
And I want to hit on this because I think it's really important. You talked about the three phases of the life cycle: build the book, maintain the book, cruise towards retirement or an exit. And we were reflecting on, why is it flat? Root causes and things like that. And I think one of the things that we talked about is this notion of will and desire, and then secondly, sort of the capacity. And it sounds like there are some firms out there, some individuals, maybe they just don't have that desire. Maybe they've got a good book, a business. They've got a good income and they're happy. Maybe they're playing golf Thursdays and Fridays and don't want to spend that time.
Right.
And I think in some cases the capacity is not there.
The capacity isn't there because if you've reached that point where and many advisors do, and maybe they're a single advisor practice, or maybe they have a partner they started with, and maybe they even pick up a junior person along the way, but usually like they fill up their book and they don't have a ton of excess capacity, and then the question becomes, all right, is there an incentive or a reason to change? And my point was, and I don't, you only have so many words you can say in an article, but like, I don't judge that. Like, there's no judgment about this. It's just people are running their practices the way they want to, and they don't have an obligation to do it any differently, right? They don't have shareholders, they don't have boards. It's really just for them, and if they have partners and their employees, they have an obligation to their clients, and they have an obligation to their employees. And but as long as they're maintaining the standard of service and care for their clients, and as long as their employees are happy doing what they're doing and feel like they're reasonably compensated for what they do, and as long as the advisor is happy and feels like they're reasonably compensated for what they do, again, they're not trading like a stock. They don't have to have growth every year to just maintain their value.
Right, right. And so that's sort of the will desire, right? I've built my book, I've spent a lot of time, and now I'm sort of in maintenance mode. Maybe I'm, sort of at the tail end of my career. The other thing that we talked about is capacity.
Yeah.
And I think of capacity in two ways. One, knowledge, know-how, and two, capital.
Right.
You said something very pointed to me when we chatted last time. You said, look, growth costs money,
Yeah.
and it does. And so I'd love to get your perspective as you think about organic growth. Do you think in terms of lifetime value relative to the cost to acquire a customer? If you look at a new client and say the lifetime value of that client is $50,000, $100,000, whatever that may be, are you thinking about that lifetime value relative to how much you would spend to acquire them? I mean, that gets to
Yeah.
the money factor and the capacity question.
So one of the things that I think probably is happening, and I obviously am one of those firms that where we are, investor backed and are pursuing both organic and inorganic growth, is that firms that have maybe more capacity to invest, or have management that is just focused on managing and building the firm and aren't client facing advisors, can both take that perspective. It's not just having the money, but also having the time and maybe the perspective of, we're investing in growth anyway. This is what we're here to do. And so what are the different components and levers of growth, and what do they each cost? And so one of the things I mentioned in the piece, which I thought was an interesting reference point, was Michael Kitces, who's well known. He had a piece, I think it was last year, and I saw him say this at the Future Proof conference last year, that the average firm, and this was, I guess, from, I don't know, his own study or studies he's seen, the average a typical firm only invests 2% of its revenue towards growth. And yet the point he made was, if you would go sell your firm to one of these aggregators, they're going to pay 2 to 3 times revenue for your business. And that's kind of on a recurring revenue, on a recurring business, that's kind of in the ballpark, I think. And so, I mean, the point was, you're massively underinvesting in growth. But as an individual advisor who's, let's say, maybe doing 2 million a year in revenue on a $200 million book, they're obviously not going to go invest 4 million, 2 times their revenue to add, or even 1 times to go add another couple million in revenue if they could, which would be worth much more on an exit multiple basis, on the exit basis. But so I think bigger firms that are focused on this do have the ability. You still have to do it. You still have to have the focus, and you have to have the culture, but have the ability to invest and look at, okay, if your point of like a customer that is going to generate 50,000 a year in revenue, what would we be willing to spend to get that? And of course, there's a lot of ways to look at it. You could look at, customer lifetime value and use like, okay, they should be here for 8 years, so that's really $400,000. So we'd be willing to pay what what percentage or what ratio are we willing to pay? I think, we look at it internally on a more programmatic basis, like what are our different channels of growth and what are they costing and what should they be worth to our shareholders over time? And we in our company want to have many, many different legs of growth. So, but yes, we do look at customer lifetime value or customer acquisition costs and lifetime value ratios and things like that. But I think we're more driven by, is this working or is this not working?
And you've been at this for a while, and I think you can tell pretty quickly if a campaign is working, a channel is working, things like that. Yeah. Let's talk about the treadmill effect. This is fascinating to me. Inflows and outflows. You're going to lose clients. You're going to have RMDs. If you're expecting that same return on your invested capital, running your firm, as those outflows happen, you got to, that speed of that treadmill is going to get a little faster.
So there's always obviously, there's a withdrawal rate. There's systematic withdrawals. There's non-systematic withdrawals. Every advisor knows this. And there's a termination rate. It's generally really low. The industry as a whole has a really high retention rate, but even if it's 2 or 3% a year, which is kind of, I think, what the average is across the industry, that's still 2 or 3%. And if you want to stay where you were, you need to replace that. So you're going to have contributions from clients, but you're going to have withdrawals and you're going to have some losses. And so, I look at it as it is a treadmill. You have to, if you're completely standing still, you're going to go backwards. And the more your business has outflows, the faster that treadmill is going, and the faster you need to go just to keep the same view, just to stay in the same place. And the way I think about it is then if you add it in, which none of us want, but you add in like any kind of sustained market downturn, either the speed of the treadmill is faster, or you could think of the incline of the treadmill being higher, and it's just that much harder to even possibly stay where you are. You probably won't. And so it's just, again, it's something that if you're operating a practice, you need to recognize that even if you're not focused on a growth goal, you're going to have to maintain some ability to continue to bring in new clients just to stay where you are. Big corporations will just cut. They will cut. If sales slow down, they'll reduce personnel costs. Maybe if they're in manufacturing, they reduce output. They might not be able to preserve all of their earnings, but they have levers they can pull to keep earnings closer to where they were. And they'll cut as a matter of course, even when things are good. And then they'll add. But in this business, you don't really have that option because let's say you have a market correction. That is when your clients need you the most. And you better be more present, more available, and more in front of your clients and communicating proactively. You can't, if you cut your staff, guess what? The signal you're sending to your clients is, at this time when I really need to be earning my fees, I am going to be reducing my capacity to serve you, right? Like, terrible message. And probably isn't even practical for most advisors anyway, because they need their teams to do the things their teams do. So you are in a position where your income is down, your staff's income is probably down if there's any kind of bonus component to their income, because there's no money, but your workload is up. And obviously, organic growth is not a cure-all for everything, but the point here was firms that have been growing all along and have maintained a strategy to grow and the capacity to grow and an investment in growth, that's actually a time when they can probably accelerate and leapfrog people, because you're going to have clients who are upset and confused. Now, people tend not to want to move in times of total crisis, but then when the crisis lifts, they kind of tend to look, is what I've seen over the years. But you're going to have advisors who are going to be hiding a little bit. It's true. Like, there's some people who are right out in front. Some people are like, oh, geez, I don't know what to do. And I've forgotten what this is like. And if nothing else, if you can be going out and adding new clients, you can at least be refreshing sort of your book and giving your team positive things to work on top of the day to day. And So I think that's, again, there'll be moments in time, hopefully they won't be sustained, but there'll be inflection points where the growing firms are going to take even a larger share because there's, the tide's going to go out and there's not going to be a lot of people there that are competing for those clients. And so it's going to happen.
Yeah.
When?
Yeah.
We don't know.
Well, we'll see. We'll see. So you're an acquirer. I
Yeah.
think if memory serves, you've acquired 9, 10 firms
Yeah.
since you started. So I'm curious to get your perspective on valuations of firms with low or no organic growth versus those with organic growth. How do you look at them from the acquisition side of things?
I think at surface level, it might not be apparent that there's a difference because valuations are high right now relative to the last 15 or 20 years. And so I think there's a little bit of the rising tide lifting all boats. But even if you hear a headline number about a deal, they all have lots of different components and subcomponents and features. And, I think that there's no doubt but that firms that are growing at higher rates are going to get a premium, are getting a premium. It may come in the form of more competition. It may come in the form of better terms. It may come in the form of higher multiples. It may be all of the above, just being able to sort of drive the outcome that they want more so than other firms might be able to. I do think it is kind of I don't want to overstate this right now. I think right now is a little bit of a golden age for RIA sellers. There's so many buyers out there, and there's so much funding coming into the space, and I think there's plenty of room for value creation beyond what acquirers are paying for the firms that they're buying. So I don't think there's a problem there. I do think though, when and if we do hit a point where the markets pull back a little bit and you don't have that sort of underlying sort of market inflation of revenue and AUM and profits, that probably organic growers will have an even bigger premium over non-growers. But I think it's like anything else. I mean, you can look at, like, if you look at real estate, you look at houses. I live at the beach. The ocean is right here. You can't see it, but the ocean's right here. I'm in my office. It happens to be over the ocean, and my house is near the ocean as well. On one side of the street, you have homes that have ocean views, and on the other side of the street, you have homes that might not have an ocean view, or that don't have an ocean view, right? You look at the market, you can have the same size house. The house that has the ocean view is definitely going to get a higher price per square foot than the house that doesn't have the ocean view. I do think it is probably more clear cut for bigger firms when they go to recapitalize or monetize that they need to be growing organically at higher than industry rates to command premium multiples, because they're looking for an even higher multiple than what they've been buying things at, of course.
To summarize, organic growth is being on the ocean, something like that, right? No, I think it's a fascinating analogy. I mean, like you could be, off the coast, and there will be differences from one to the next. And yeah, I think it's how firms think about what they'd want to pay in a multiple. And then what that means to them, as you said, as they look to recapitalize their firms, and how do they value that growth that the acquired firm brings. Organic growth is important. It could be a multiple multiplier. Love to hear your thoughts on where and how you're investing.
We literally wrote a business plan and started the company with this in mind, with a focus on knowing that we were going to acquire great firms and great people, but that we didn't expect that they would be growing organically at the rates that we know we need to kind of reach our goals as a company. So from the very outset, and we said from the very outset to people who are interested in investing, that we're going to build an organic growth function that is a central function for the company, and then kind of have that serve all of our offices when they come on board. So again, this is something, if you're running an individual advisory practice, you can't do this, but you can. I'll get to in a second what you could do. But what we've done is we built something we called or organic growth hub, where we have a team of people who are employees of the company, and their job is actually to reach out to prospects who come in from any one of a number of sources. They might be people who reach out to us. They come to us through content we produce. Because we do, we obviously do stuff through website, but we have podcasts, we have a YouTube channel, we have different ways to hopefully reach people. So they might be coming in from that source. There's other lead sources that we participate in. And so our goal with our concierge hub is to have someone talk to that prospect who's not the advisor, who's going to end up being the advisor who they meet with, because this is the capacity issue. It's a very disruptive thing to be talking to leads, and in particular, in the firms that are doing sort of more bigger or organic growth strategies. These are not referrals of like a close friend of a client. That's what most people are used to. They're used to sort of like, okay, I'm meeting with, you know, your brother-in-law, and you've told him how great I am. So he's already kind of pre-sold. If you're going to grow at bigger rates, you're going to end up having to talk to some strangers eventually, because you're going to run out of the referrals.
Referrals are hard to scale. It's just
Well, they're hard to
nature
scale,
of the
and
beast.
there are great strategies around referrals, and there's lots of things people do with like, let's curate great client events and bring a friend and stuff like that. And it works, but the more mature your practice gets, the less likely that is to work, because the friends of your clients are all people who, if they are good candidates to have an advisor, they probably have one.
Yeah. Yeah. Or you've talked to them already.
Or you've talked to them already over 20 years, and they're like, yeah, I heard from you already, Gary. I'm like, yeah, I'm good. So you have to be able to like have a way to meet with people who you don't know as well, and that's time consuming and disruptive. And the reality is you have to talk to a lot more people to get to the ones who are real prospects. So we said this is just an investment we're making as a company, and it benefits our firms that they don't pay for it. It's not directly. So the concierge team talks to prospects, and the goal is to do some information intake, see if they're qualified, if they would be a qualified client for us, and set an appointment with an advisor.
Critical. And I love the concierge notion, and that the pre-qualification process, where I'm sure it's a series of questions, it's an information gathering process, where you can determine pretty quickly, is this the right type of lead for the firm, based on any minimums or specific requirements you have. So you've got, I think, a really interesting people side of it. And when we chatted last time, we talked about 4 areas where you invest: so technology, people, marketing, and PR. Tell us a little bit more about those investments.
PR is maybe something more tuned for bigger firms, but smaller local firms can do it too. It's just a way to raise visibility and awareness about what you're doing. It could be, their local business journals or other sort of outlets where people hear about things, and it just creates credibility. All these things are about creating awareness and credibility, right? Marketing is obviously a many sort of factored sort of thing, like it can be a lot of different things. And I know there's some really good firms out there that you can hire to do outsourced marketing for you, sort of like CMO for hire kind of firms that can build a marketing program that can, your presence, not just your website, in some cases, maybe social media, help with messaging, help with materials, even branding and look and feel. But I mean, listen, it creates an impression in the minds of people who are interested in working with you. For us, I think things like podcasts, which we have some of our advisors had a pre-existing podcast and YouTube channel when they joined us, and so we've leveraged that, kept it, and tried to enhance it as well. It's super interesting because what we've observed is when prospects come in, for example, if they see you on YouTube, they there tends to be a feeling like they already know you. They already kind of trust you. They already kind of trust the advisors. There's already a relationship there. So it's a massive credibility enhancer if you can do that, because it's just like, it's not just, because let's face it, like every firm kind of has a name that sounds almost the same, talks about, your trusted advisor, here for you and your family, building a long-term plan, et cetera, et cetera. It all looks the same. The images all kind of look the same.
That
Like
that
everyone's
60-something-year-old couple hand in hand walking down the beach with the sunset. Yeah.
right. The 60-something-year-old couple wearing like gauzy white clothes, but when you look, their hair is white, but when you look at their faces, they really look like they're 45. And, like, yeah, that like we all want to be, right? So if you step back and think about it from a potential client's perspective, it's like, well, how do I cut through the noise? Which is why most people over the years have picked an advisor because, well, I kind of know this person, or my buddy works with them and says they're good, or they pick a big firm like, where it's like, well, no one's going to say I'm dumb for picking this name brand firm because they're a name brand firm.
Yeah.
I'm not
Yeah.
going to
Yeah.
name any. Um, so how do you cut through that clutter, right? And uh, there's so much media out there now. Like, I mean, again, people, when 20 years ago, like get a radio show, et cetera, that's probably harder and declining in terms of value. So if you're going to do something podcast or online, you're going to have to also do some marketing around that, some digital marketing to try and drive people, but it works.
Yeah. 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 And I think it's a must have. I'm a marketer, so of course I'm going to say
Right.
that. But, all right, let's hit the last question here. I love the perspective that this question often delivers. But so given what you know now, if you were to go back 5 years ago and your early stages of building Modern, what would you take about what you know now and apply back then?
The biggest takeaway I would have, and it's maybe more what I've seen over time, is being very honest internally about who does and who does not want to participate in growth, and not necessarily having that be a winner loser thing. And when I say this, I mean, if you're in a multi-advisor firm, let me just create a hypothetical firm that has two founding partners and two junior advisors, and they've built a $500 or $600 million book over time, and they're kind of running steady. Let's not try and pretend. I mean, since football season is going to start soon, I'll make a football analogy. Let's not pretend everyone should be playing quarterback, right? Like, you can't have a team with everyone playing the same position all the time. And even worse, trying to play quarterback, running back, offensive line, D line, whatever. Kind of build out your roster and figure out who is focusing on what and maintain that focus. So if someone loves closing new business, meeting with prospects and closing new business, clear their deck and let them do that. If someone is like, I love meeting with our clients, I love, iterating on the financial plan, I love doing, the semi-annual or, however frequently the meeting is, clear the decks and let them do that. So actually have the roles and responsibilities of the people in the firm line up to their skill sets and their passions, and not try and just be like, what did you do this week to grow? I'm like 7 years behind watching Billions, the show, but if anyone here has watched Billions, it's like, it's a hedge fund, and it's going around the room like, who's figuring out how to make us money today? Who's
Yeah.
got a great idea? Who's going to make a trade to make us money today?
Yeah.
It's like, okay, well, that might be the way that needs to function in reality or in fiction, but an advisory firm doesn't have to function that way. You have to cover all the bases. So have different people covering different bases based upon what they actually love to do and what they're actually great at.
The right people in the right seats.
Exactly.
Yeah. Yeah.
And it sounds simple, but it's harder. It's harder to actually do, and it's
Yes.
often overlooked.
Yeah. Yeah. It can be a challenge for sure. Gary, it's been a pleasure. Love chatting with you. I think we could spend another hour chatting about this stuff, but we've got to wrap it up for now.
Yep.
Again, really appreciate your time. Thank you so much for joining
Thanks,
us,
Dan.
and we'll talk again soon.
Thank you for listening to the Grow Organically podcast. If you enjoyed this episode, click the follow button to be notified when new episodes become available. Visit catchlight.ai, where you can access all our podcasts, including show notes and other resources to keep learning. This podcast was produced by Catchlight Insights, LLC. It is for informational and educational purposes only. The content of this podcast does not constitute an offer or recommendation of any securities and is not intended to provide tax, legal, or investment advice. The views expressed are those of the speakers and not necessarily those of Catchlight or its affiliates, and are as of the date indicated, based on the information available at that time, and may change based on market or other conditions. Catchlight does not assume any duty to update any of the information. Catchlight and other third parties mentioned in the podcast are independent entities and not affiliated. Catchlight does not endorse any investment advisor or provide advice or recommendations to any prospective or existing client of an investment advisor as to the selection or retention of that investment advisor. The information is not intended for any person or entity in any jurisdiction where the distribution or use of such information would be contrary to local law. Third-party trademarks referenced herein are the property of the respective owners. All others are the property of Catchlight Insights, LLC, copyright 2024 Catchlight Insights, LLC. All rights reserved.